All right, if you're hitting the books for your insurance exam, you know exactly what I'm talking about. There are some words in there that just feel tricky, like they're designed to trip you up. Well, today, we are going to tackle one of the biggest ones head on. By the end of this, you'll be walking into that test feeling way more confident. So, let's dive in.
Yeah, this is the one, right? Aleatory. It looks kind of weird, it sounds weird, and you can pretty much bet it's going to show up on your exam. So what on earth does it really mean? Stick with me for just a few minutes because we're going to make this so simple you'll actually be hoping you see it on test day. Seriously.
So let's just cut right to the chase. What is the simple, direct answer you need to have locked and loaded for your exam? No fluff, just the good stuff.
Okay, here we go. This is it. This is the definition you need to burn into your brain. An aleatory contract. It's just a contract where the two sides might exchange unequal amounts of value. And why? Well, it's because the payment totally depends on some uncertain thing happening in the future. That's the whole ballgame right there. Unequal value because of an uncertain event.
Here's your mental shortcut for the exam. If your mind goes blank, just remember this. You pay your premium for protection, but the insurance company only pays if the bad thing actually happens. The whole deal hinges on a what if.
All right, now that we have the definition down, let's make it real. How does this actually work with insurance? This is where the light bulb is going to go on.
Okay, this comparison just nails it. Think about it. You go to a store, you buy a chair. You pay, say, $50. You get a $50 chair. The exchange is equal. Simple. But insurance? Whoa, that's a different story. You pay your premium, right? And then what happens? Maybe nothing. You could pay for years and get zero back. Or something bad happens and the insurance company pays out this huge amount, way, way more than you ever paid them. See, that possibility of a lopsided, unequal exchange, that's the whole idea of aleatory. Let's look at life insurance. A person could pay premiums, maybe a few $1,000s over several years. Then, if they pass away, their family could get a check for, say, $100,000. That is a massively unequal exchange, right? But it only happens if that uncertain event, death, occurs. That's a perfect example of aleatory in action. And it's the exact same logic with property insurance. You pay your homeowner's premium every year for fire coverage. You might do that for 30 years straight and never have a single spark. In that case, you've paid in and the insurer has paid out nothing. Or a fire could happen next week and the insurer pays to rebuild your entire home. The whole outcome hinges on that unpredictable event.
Okay, pay close attention here, because this is super important. Now that we know what aleatory is, we need to be crystal clear on what it isn't. These are the common mistakes that can cost you easy points on the exam, and we're not going to let that happen.
This right here is the #1 trap. People hear unequal exchange, and their brain immediately jumps to unfair. So let's just tackle this head on. Does aleatory mean the contract is unfair?
No, absolutely not. This is so important. Aleatory has nothing to do with being fair or unfair. It's just a technical word, okay? It simply describes how the contract is built. It's built on chance. You know, that potential for an unequal payout, that's not a bug, it's a feature. It's literally the entire reason insurance can even exist. It's totally normal.
And here's another spot where exam questions love to get tricky. They mix up similar sounding terms. So let's break this down. Aleatory is all about that uncertain event, about chance. Unilateral, that just means only one side, the insurer, makes a promise that can be legally enforced. And adhesion? That's the take it or leave it part. You accept the contract as is. You have to know the difference. So if a question mentions an uncertain event, your brain needs to light up and scream aleatory. Okay, deep breath. You have the definition, you've seen the examples, and you know the traps to sidestep. So now, let's see what this actually looks like in an exam question. Let's put this new knowledge to the test. Okay, first one. What does the term aleatory mean in insurance? Is it A, written by the courts, B, depends on an uncertain event, C, can only be canceled by the insurer, or D, requires equal exchange of value? Come on, you know this. Think back to that core idea.
And if you said B, you nailed it. Absolutely correct.
See, that's it. That's the connection you have to make every single time. Aleatory equals uncertain event. It's the key that unlocks the question.
All right, one more for good measure. This is a why question. Why is a life insurance policy considered aleatory? A, the insurer always pays back what was paid in. B, the benefits depend on an uncertain event, like death. C, both parties have to perform equal duties. Or D, the contract is always temporary. Think about the life insurance example we just talked about.
And once again, B is our answer. You're on a roll.
That's the logic. It's aleatory because that huge payout, the death benefit, is completely tied to a future event that no one can possibly predict for sure. It has nothing to do with equal duties or how long the contract lasts. It all comes back to that uncertain event. Okay, so let's lock this in before we finish. This is your 3-point memory lock. Get this down and you're golden. Number 1, aleatory means it all depends on an uncertain event. Simple. Number 2, for insurance, this means the company only pays out if a loss actually happens. And number 3, the value, what you pay in versus what they might pay out, can be totally unequal. And that's okay. That's just how it works. If you can remember those 3 things, you are going to nail any question about aleatory contracts on your exam. You've got this.
Hold on, don't click away yet. Look, passing the life insurance exam is a big hurdle. But do you have a real plan for what happens the day after you get your license? I've been in the industry since 2011. I've lived the nightmare of driving across the state for a confirmed kitchen table appointment only to have them not even open the door for me. It's a grind that kills most careers before they even start. During COVID, I stepped away. I let my license expire to build the crown jewel for this industry, Priority Score AI. I realized the biggest hurdle for agents isn't just selling, it's the tech nightmare of launching ads and connecting leads. I built this to be your automated marketing department. With a few clicks, you bridge your Meta account, generate AI videos without a camera, and let the engine score your results so you only talk to the winners. We're building a team that leads with technology. Click the link in the description right now to see the crown jewel I built for this industry. I've got a video waiting for you that explains exactly how we're changing the game by automating your leads and scoring the best in real time. Get on the list.